You know, every single day, banks are up against this huge, kind of invisible challenge. It's not about high-tech heists or anything you'd see in a movie. It's something much more fundamental to their very survival. So today, we're going to pull back the curtain on the single biggest reason banks get into serious trouble.
So what is it? What is the number one threat? And you might be thinking, oh, it's got to be a market crash, right? Or maybe some rogue trader. But nope. While those are big deals, the real danger is something that's baked right into the DNA of banking itself.
And that brings us to this, credit risk. Sounds kind of boring, I know, but it's this really simple but honestly terrifying idea. The chance that someone who owes the bank money just doesn't pay it back. Could be a mortgage, a huge corporate loan, doesn't matter. And make no mistake, getting this wrong is the number one reason banks fail. Period.
All right, so here's our game plan. We're going to dive into what credit risk really is, see how banks organize themselves to fight it, take a peek at the high-stakes world of the trading floor, check out the global rulebook they all have to follow, and then, and this is the really cool part, we'll break down the difference between the losses they expect and the ones that can actually bring down the house.
Okay, first up, organizing against risk. So, how does a bank actually build its defenses? Believe me, it's no accident. Their entire internal structure is basically one big defense mechanism.
So check out this quote from the rulebook. What's so important here is this principle of separation of powers. Basically, it means the people trying to sell you a loan, you know, the ones who make a commission, they cannot be the same people who decide if that loan is too risky. It's all about having an independent, sober second thought to stop the bank from getting too greedy.
And you can see this separation in action through the whole life of a loan. First, you've got credit origination. That's the business side, the bringing in the deals. Then it's handed off to monitoring, where a totally separate risk team is keeping a close watch on things. And if things start to look shaky, well, it goes to the workout team. These are the specialists who come in to try and recover the money. 3 distinct stages, 3 different teams.
All right, so we've talked about traditional loans. Now let's jump over to a totally different beast, the trading floor. The pace is way faster, but credit risk is absolutely still a huge deal here. It just looks a little different.
On the trading floor, you're really worried about 2 main types of credit risk. You've got settlement risk. That's pretty straightforward. It's the day the deal is supposed to close, you pay your side, and crickets. The other guy doesn't pay. But then there's counterparty risk, and this one is a bit trickier. It's the risk that your trading partner goes bankrupt before the deal even settles.
And this is where it gets really interesting and kind of counterintuitive. Think about it like this. You and I agree to a currency swap. The moment we sign, the deal is worth 0, right? Neither of us owes the other anything. But what if the currency markets move heavily in your favor? Suddenly, that contract is a massive asset for you. If I go bust then, you don't just break even. You lose all that potential profit you were counting on. That's the risk.
Okay, so if every single bank is dealing with these same kinds of risks, who's the referee? Who makes sure they're all playing by a common set of safety rules? Well, that brings us to the global rulebook. We're talking about something called the Basel Framework. Yeah, it's named after the city in Switzerland where all the top central bankers meet. And it's not static, it has evolved a ton. You had Basel I back in the 80s, which was pretty basic. Then came Basel II in 2004, which got a lot more sophisticated. And then, after the 2008 financial crisis, we got Basel III, a massive overhaul designed to prevent that kind of meltdown from ever happening again.
So this is Basel III in a nutshell. You can think of it as the global instruction manual for running a safe bank. It really boils down to 3 main ideas, what they call pillars. Pillar 1 is all about capital, having enough of your own money to soak up losses. Pillar 2 is about risk management, basically having your house in order. And Pillar 3 is liquidity, making sure you have enough cash to survive a panic.
Pillar 1 is really the main event. It's all about capital, the bank's safety cushion. And after the crisis, the regulators didn't just say we need more capital. They said we need better quality capital, stuff that can actually absorb losses when things go bad. They also threw in a simple backup measure, the leverage ratio, which basically says, hey, you can't just borrow insane amounts of money. I don't care how safe you think your investments are.
Then you have pillars 2 and 3, which are like the support crew. Pillar 2 is about supervision. It gives regulators the power to look under the hood and make sure a bank's internal risk models aren't just fantasy. Pillar 3 is about market discipline, forcing banks to publish more data so everyone can see who's being risky. And crucially, Basel III brought in brand new rules on liquidity to make sure banks can actually survive a 30-day storm and aren't just relying on overnight loans to keep the lights on.
So we've talked about internal teams, trading floor risks, global regulations, but all of it Every single rule comes down to understanding one core concept, and that's the difference between expected loss and unexpected loss.
All right, so what's expected loss? Well, it's exactly what it sounds like. It's the losses a bank expects to happen. It's a predictable cost of doing business. They know that for every 1,000 mortgages they issue, a small, predictable number will default. It's not a surprise. It's just a line item in their budget, covered by the interest they charge everyone else. Unexpected loss. Now this is the one that keeps bankers up at night. This is the stuff that goes way beyond the average. It's the big, ugly surprise. It's the deep recession where suddenly everyone starts defaulting. It's not a budget item, it's a full-blown crisis that can bankrupt the bank.
And these charts do a great job of showing what we mean. Look at the graph on the left. You see the losses bouncing around an average line? That average, that's your expected loss. Now look at the chart on the right, the probability curve. That big hump in the middle? That's where you expect to be most of the time. But see that long, thin part stretching out to the right? That's the tail. That's the unexpected loss. It's not likely to happen, but if it does, the losses are huge.
And this brings us to the single most important takeaway of this entire discussion. Bank capital, that safety buffer we talked about, it's not for covering those everyday expected losses. Nope, the bank's profits and provisions handle that. Capital is the emergency fund. It's the break glass in case of fire money that is there specifically to absorb those massive, unexpected losses. It's what allows a bank to survive a crisis, and that is why regulators are so obsessed with it. So that leads us to the big, lingering question, doesn't it? We have all these complex models, these independent risk departments, this massive global rulebook that was written in response to the last disaster. But is it enough? Are we truly safe from the next financial crisis? That's the billion-dollar question.